Is the inflation fight over? Well, there's some little known information about inflation that has really not been covered that heavily by the traditional media, which I want to talk about because what we've been hearing a lot is that inflation has fallen to the lowest levels that we've seen in a couple of years, with CPI coming down all the way to 3%. And this naturally has a lot of people wondering, is the inflation fight over? Are interest rates going to fall sometime soon? And does this mean that my grocery prices are finally going to start falling? But let's dive a little bit deeper into this because there's some interesting pieces of information that really isn't broadly covered. Now, just so we're on the same page, the Federal Reserve Bank is the central bank here in the United States, and they're the entity that's in charge of trying to bring inflation down. And one of the ways that they're trying to bring inflation down is by raising interest rates. So the reason why mortgage rates are so much higher now than a year and a half ago is because the Fed has aggressively raised interest rates. And the Federal Reserve Bank now is the entity that's closely monitoring the inflation numbers to decide what they want to do with monetary policy, meaning what are they going to do with interest rates? What else are they going to do to help stimulate or slow down the economy? Now, if you've read any headline on inflation recently, most of them have read something kind of like this. The Consumer Price Index, or CPI, which measures inflation, increased 3% from a year ago, which is the lowest level since March 2021. This is from CNBC. CPI, or the Consumer Price Index, is one measure of inflation. But the real question is that the right measure of inflation to really be paying attention to? And the answer is really, it depends who you're asking. And so if you want to understand what the Federal Reserve Bank is going to do when it comes to inflation, you have to understand what is the Federal Reserve Bank looking at when it comes to inflation. So let's go to the Federal Reserve Bank's website. On the Federal Reserve Bank website, it says that the PCE price index, or the Personal Consumption Expenditures Index, is the Federal Reserve Bank's preferred way of measuring inflation. So now we have two different measures of inflation. We have CPI, which is also known as headline inflation, which is what a lot of media companies have been covering. And then we also have PCE, which is also known as core inflation, which is what the Federal Reserve Bank likes to look at when it comes to raising interest rates. So we know that CPI has fallen to 3% according to the reported numbers. But what about PCE, or core inflation? If we take a look at core inflation here, the latest core inflation report said that core inflation has fallen to 4.8%. And what you see is that yes, core inflation, PCE inflation, has fallen off of its highs, but its highs were 6.6%. So we are still closer to the highs of core PCE inflation than we are to the target 2% inflation. See, if you've been following this channel or if you read market briefs, you know that the Federal Reserve Bank's target inflation is 2%. Now, when CPI comes in at 3%, everyone says, oh, we're right next to our 2% target. The inflation fight is over. But the question is, which inflation numbers are you actually looking at? Because the Federal Reserve Bank isn't really looking at CPI the way that a lot of people are. The Federal Reserve Bank says publicly that they are looking at the PCE index. And the PCE index says that inflation is still at 4.8%, which is still significantly higher than 2%. And this is where that real fight on inflation is bringing this PCE index down even lower. And the PCE index is essentially you take the CPI inflation numbers and then you remove some of the volatile numbers like food and energy, and that's what brings you this core inflation number. So the Federal Reserve Bank is looking at this PCE number and they're saying, how can we bring this lower? And the balance that they have to play is, how can we bring this lower without breaking the economy? Because we've seen the effects of higher interest rates. They slow down the economy. Higher interest rates mean higher mortgage rates, which slow down the housing market. Yes, the housing market's still strong, but imagine how the housing market would be if mortgage rates were still at 3%. But this inflation discussion gets even more interesting when you take a look at what's going on with the dollar and when you take a look at what's going on with the BRICS nations. Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in the top housing market, stock market, and economy news. It's completely free. You could read Market Briefs in less than 5 minutes every morning, and I promise you, you're going to love Market Briefs. And if you say, but Jaspreet, what if I don't love it? Well, you can unsubscribe whenever you want because it's completely free. So if you have not joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. There's a couple different things happening right now. Number one is when people see the headline inflation number falling, a lot of people think the inflation fight is over. When people think the inflation fight is over, they assume that the economy is going to boom, and then that creates more spending and more boom in the markets, which interestingly is a tool for more inflation. See, because when people see inflation falling, what do we see happen in the markets? The markets start to boom. This is what we've seen happen in the last few inflation reports, that as inflation falls, people go out and they start putting money into the markets and they start spending again. But what is that going to do to demand? If people are spending more because they feel like inflation's falling and demand starts to rise, well, that produces more inflation. And so that's kind of the interesting first thing that you want to pay attention to, because we could be seeing more inflation due to more demand created by people's perception of inflation falling. That's the first thing that you want to pay attention to. The second thing that you want to pay attention to is the dollar, because our dollar is our currency here in the United States, which is the obvious part. But the interesting thing is, when you have high inflation, the value of the dollar goes down. When you have lower inflation, the value of the dollar should go up. But what we saw happen when the most recent inflation report came out, which said the CPI fell all the way down to 3%, the dollar actually fell. The dollar fell to some of the lowest levels that we've seen in a couple of years. And now if you think about this, why would the dollar fall, the dollar value fall, when inflation is falling? Because if inflation's falling, you'd think that trust for the dollar would be going up. And this is where now you have to kind of just put in your own guesses. Why are people or investors worried about the health of a dollar? That's why the value of the dollar is falling. Why would people be worried, or why would the dollar value fall if inflation is falling? Generally, that would happen when you see higher inflation. And maybe that's because investors are worried about the true inflation that we have. That maybe the inflation problem is not over, that maybe this inflation might be around a little bit longer. Maybe the Federal Reserve Bank will pivot a little bit earlier. If the Federal Reserve Bank pivots a little bit earlier, that would cause more inflation in the future, right? Investors make decisions not based off of what's just happening today, but based off of what they perceive in the future. And so it's interesting to see that we're seeing inflation levels fall, yet the dollar was also falling at the same time. And then on top of that, something that you want to pay attention to, especially when it comes to the dollar, because inflation, our dollar, our currency, all get tied into one another, is what are other countries doing in regards to the dollar? Because what we've been seeing happening recently, very recently, is that the BRICS nations, Brazil, Russia, India, China, and South Africa, have been coming together to create their own currency. In fact, they just met again in June 2023 to talk about how they can create their own currency to divest themselves and diversify themselves away from the dollar. And the interesting thing is that the new currency that they want to create is likely going to be backed by gold, or at least that's what the rumor is, that they want this new currency to be backed by physical gold. So what are we seeing happen? We're still seeing high inflation. We don't know what the Federal Reserve Bank is going to do. There's a chance that the Federal Reserve Bank will pivot. If the Federal Reserve Bank pivots to save the economy, that could create more inflation. We are also starting to see a slowdown in the economy. How much? Well, we don't really know, because people are still having money to spend. But then we also have these BRICS nations at the same time, as kind of this icing on the top, working to create their own currency to diversify themselves away from the dollar. Now, is that a direct threat to the dollar? Most people will tell you no, but the reality is, if more and more countries are trying to move away from the dollar, what does that do? It ultimately just creates less demand for the dollar. Our dollar isn't backed by any precious metal. It's not backed by anything besides the health of our government, the strength of our military, the strength of our economy. And so if we have more and more people that stop using dollars, or we have less demand for dollars, that would hurt the value of dollars. And if the value of a dollar is dropping, that also can create more inflation. So this is where your job is to understand not just what's happening, but understand how you can understand this information for yourself. Because yeah, there's a lot of information out there about what's going on with inflation. You want to really understand what's going on with inflation. That way you can be an educated investor and be a prepared investor, because anytime you start to see slowdowns in inflation, what happens? People say, oh, the economy is all good. There's nothing to worry about. The fight on inflation is over. But you got to take a look at everything from a broader lens and be patient as well, because there's a lot of different things happening in different parts of the economy and different parts of the world. That way you can understand how each piece plays a part with one another And that's why you don't want to be blindsided. So number one, you got to stay up to date on what's happening. That's where market briefs can help you. But then also number two, you want to be financially educated, learn about investing, learn about how you can find good opportunities, whether it's in stocks, whether it's in real estate, whether it's in whatever. And then number three, you want to work to be getting prepared right now, because no matter what happens, it doesn't hurt you to be prepared. Have cash put aside to protect you against an emergency, and then have cash put aside to be able to capitalize on opportunities. I've been saying this for a while now, but 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart and put that money aside. That way you can capitalize on opportunities that might be coming your way. Big banks are noticing the shifting tides in the economy. Take a look at this article from Financial Times. It says, the largest U.S. banks are set to report their biggest jump in loan losses since the onset of the COVID-19 pandemic. The banks, JP Morgan Chase Bank, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and